Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. We are receiving a higher than usual number of inquiries from our clients about whether they should reduce their exposure to the US stock market because valuations are so stretched. Our response has been not yet. Most of the scaffolding holding up this bull market is intact. The topic of this video is one of the most important elements of this support, which is the optimism in the lending market. That optimism has reached exceptional levels. And here I'll discuss how changes in the loan market can be an early indication of what's next for the stock market and how to monitor that yourself. Corporate debt can be investment grade with a quite low probability of default, or non-investment grade debt, which is also known as high yield or junk bonds, where the probability of default is higher. Because high yield borrowers might default or be downgraded, they pay a higher interest rate on their debt than the US government pays on its debt. The credit spread is the difference between what high yield borrowers have to pay and what the US government pays for debt at the same maturity. The blue line on this chart shows the average credit spread US high yield over time. At the time of this video, in mid-December 2024, that spread is 2.6%, one of the lowest ever observed. That means that on average, lenders are quite eager to loan to the more speculative companies. This chart shows the historical relationship between the starting credit spread of high yield bonds and then the amount that high yield bonds actually outperform treasuries over the following year. As you can see on the right of this chart, on average, the starting credit spread has been 4.9%. And on average over the following year, investors have kept a bit less than half of that. They've ended up with 2.3% higher return than they could have earned in treasuries. What's important for today is the set of columns labeled 1. In that decile, where investors are buying high yield bonds at credit spreads that are in the bottom 10% of all time, as they are doing now, what happened next over the following year is that high yield investors earned a return that was 4.1% lower than they could have earned on US treasuries of the same maturity because credit spreads went up. So because of this history, we believe that those who are eagerly buying high yield bonds now are not really being adequately compensated for the risk they're taking. This chart shows the historical credit spreads with added shading for the periods in which the S&P 500 stock index fell 20% or more. We can see that the move up in credit spreads has usually commenced at or before the move down in stocks. At Atlas Capital, we consider meaningful changes in credit spreads as useful or early warning signals for the stock market. You may not have ready access to data about credit spreads, but as a good proxy, you can easily monitor the price action of the bank loan ETFs, such as BKLN or SRLN. This chart compares the performance of high yield versus treasuries to the performance of the BKLN ETF. There's a high correlation in the bank loan ETFs fall when credit spreads are rising. So it's possible to monitor these ETFs for signs of a turn in lending conditions. So to sum up, currently high yield spreads are low and falling. That's a strong indication of optimism by lenders, and that optimism is also supporting the current equity bull market. These historically low spreads for high yield bonds probably will lead to regret. Investors are not seeking adequate compensation for the risk they are taking. Rising spreads can be a warning sign that stock prices are also at risk, and you can monitor that by observing the price performance of the bank loan ETFs. In general, periods like the present, where lenders are avidly competing to loan to companies at ever more favorable terms, those kinds of periods eventually lead to regret, where lenders who loan at the end of the cycle regret the choices that they made, and then prices for loans and stocks reset downward. So we're watching that closely. At Atlas, we're currently advising clients to stay the course, But if there's a shift in lending conditions, then that would raise our concern about what's next for the stock market. Thanks for listening. At Atlas Capital, we're in the business of advising clients to form investment portfolios which meet their needs. And for more information about evidence-driven investment strategies, you may visit our website at atlasca.com. You may also write to us at info@atlasca.com.